it also includes retained earnings. So sometimes, so in these organizations, they will have what we call shareholders. So shareholders, they will receive the profits, which is called dividends. But then sometimes an organization can decide not to distribute dividends to the shareholders. Instead, they are reinvesting these profits into the business. So when the organization is not distributing profits to the shareholders, and instead they are reinvesting these profits into the business to increase their capital, that one is called retained earnings, and it is part of a equity financing strategy, whereby we are financing internally based on the retained earnings and also based on issuing of shares. So that's the first one. So this one, it happens in incorporated business organizations. Business organizations that are separate from their owners. So they are called legal entities because they are artificial human beings that are created by the law. So the process of issuing of shares, it is most often, or it takes place in organizations that are incorporated. So the other one is called debt financing. So when an organization is borrowing finances from other organizations to finance its operation, that type of financing is called debt financing. So here we are not issuing shares, but then we are borrowing from someone else. So it means we have to pay these people back whatever we are borrowing. So we have to pay them interest as well as the principal. So two types, debt financing and equity financing. The first one, we're issuing shares. And then the next one, we are borrowing finances from other organizations. So two types of financing. So we also have two categories of organizations' financial needs. So by looking at these two categories, we are looking at how do organizations use these finances, or how do they use these finances? So the first category is that organizations use finances to promote their long-term investments. So two ways in which organizations use finances. The first one is about long-term investments. So an organization is purchasing fixed capital assets in order to facilitate their objectives. So that's the first one. So an example, so if we have a business and then we are having finances and then we want to use them for long-term investment, it means we can purchase, for example, land. So purchasing land is part of a long-term requirement. So purchasing a motor vehicle for you to be using in your business, it will be included as one of the long-term investment of an organization. So that's one example, one way how an organization would use finances within its organization. So the next one is about working capital. So these are long-term requirements. So we are having finances for the day and to be used in the day-to-day operations of our businesses. So apart from having these long-term objectives or these long-term fixed assets, or apart from investing in these fixed assets, organizations also have to have money for its day-to-day operations. So that one is called the working capital requirements. So for example, we want to be paying our employees. So paying employees is part of a short-term investment. Paying rent. So rent is something which happens regularly. So it's part of a working capital requirement. So these are two types of financial needs that an organization would need financial resources within an organization. So questions on these two? Yeah. 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 Mm-hmm. Yeah. Yeah. Yes. So for the long-term fixed assets or for the fixed assets, so it's this one. So the funds that are required to purchase fixed assets. So fixed assets, these are long-term assets within the organization. So the assets that stay for a period of more than 1 year. So if we have bought something that stays for a period of more than 1 year, that one, it is within the fixed assets. So whenever we are spending on the fixed assets within the organization, so that one, it means it's within the long term or the fixed assets requirement. So we can also spend on working capital. So it means, for example, we are on the working capital, it means we want to meet the day-to-day operations for our business. For example, operating functions of organization. So what happens each and every day? For example, stationary cost. So stationary cost, rent expenses, electricity expenses, all those are within the working capital requirement of an organization. So on this long term, so we are on long-term sources of finance. So by looking at long term, we mean the sources of finances that would help the organization to finance its fixed assets. And then, you know, in most times, these long-term assets, they take a long period of time for them to be paid back. So if an organization is adopting, for example, a loan, which is long-term, which is within the long-term sources, it means it has to be paid back in a period of more than 1 year. So within the long term, we have these. So these are some of the examples within the long-term sources of finance. So I said we have two types of finances, debt and equity financing. So some of these, they are within the debt financing, and some of them, they are within the equity financing. So the first one is the equity shares. So equity shares. So on this one, so when we are starting, we said an organization can use shares to invest as a source of finance in its organization. But then these shares, they are into two groups. So we are using shares, but then these shares, they are into two groups. So the first one is called equity shares. So they are also called common shares, or they are also called ordinary shares. So they are shares, and so people who wants to become one of the owners of organization, they also have to buy these shares. So once they have bought these shares, they are becoming part of the ownership of organization. They are becoming shareholders, and they'll be given dividends. But then there is a difference between these shares and other shares within the organization. So this becomes the first source of finance within an organization. So the difference is from the definition. So these people, so people who hold these type of shares within the organization, they don't enjoy some of the preferential rights within the organization. So they're having shares, but then they don't enjoy some of the privileges within the organization. So they are not entitled to some of the privileges within the organization. So what are these privileges? The privileges are coming from the way the dividends are paid and the way the repayment of capital is made. So they have bought shares, but then they are still not entitled to some of the privileges within the organization. So the first privilege which they are not entitled to is the way the dividends are paid. So on the way the dividends are paid, the first one is that this type of people, they receive dividends when other shareholders have received their dividends. So you only receive a dividend when other shareholders have received their dividends. So that's the first privilege that these people don't have. So you only receive profits when other shareholders who are not on equity shares, who are not equity shareholders, have received their dividends. So that's the first privilege that they don't have. The next one, these dividends, they are not fixed. So you don't have a fixed rate of a dividends that you'll be getting from the organization. So it means these people, they are not guaranteed of dividends. What it means that some months, these people, they may not be able to receive dividends because they are not fixed. So they don't have specific rates of dividends that they have to be receiving from this organization. So in some scenarios or in some months, these people, they may not be receiving dividends because so they don't have a fixed rate. For example, if the organization is making losses, some of these people, they may not even receive dividends because the rate is not fixed. So that's one of the privilege that these people are denied in an organization. So the next one, it's on how the capital is paid within the organization. So this one, it happens when the organization is winding up, when the organization is closing down. So when the organization is closing down, these people, they get their capital back. So they get the money they invested into the organization once, when all other shareholders have received their capital. So we'll be getting our dividends, our capital that we invested into the organization when other shareholders have received they have been paid their capital. So for example, this company is facing what we call bankruptcy. So it's winding up. So they'll be paying people within the organization. So these shareholders, they will receive their income once all other shareholders have received theirs. But then these people, they have an advantage of voting rights within the organization. So they are involved in controlling of this organization. So although they have these disadvantages, but then they are involved in controlling the organization. So the decisions that are made within this organization, some of them they are made by these people, the equity shareholders. So that's one way an organization can finance its, that's one of the long-term financing options of an organization, whereby this person is assuming the title of an equity shareholder. So it has privileges and also disadvantages. So that's the first one. So questions on this one. So if you don't want to be an ordinary shareholder, you can choose to be a preference shareholder. So if you don't want to be a common shareholder, you can choose to be a preference shareholder. So it's also one of the methods an organization can finance its operations through the usage of shares. So with this one, so it's the same. It's about shares, but then these people now they are having some preferential rights within the organization. So they are having some privileges, some entitlements within this organization, although some advantages within this organization. The first one is that as a preference shareholder, we are receiving dividends at a fixed rate. So if it's 10%, then it's 10%. So if the organization has made 10 million, then you receive 10% of 10 million as your dividend. If the organization has made 2 million, you will receive 2 million as your dividend. So this is different to a common an ordinary share, whereby the rate is not fixed. So these people, they have a chance of getting back their capital in case the organization is winding up. So the organization is going through financial difficulties. So we just have to abandon this organization. So these shareholders, the shareholders who have preference shares, they have the advantage of getting back their capital in the organization. So it means this type of financing, it's safe because we are receiving fixed rates of dividends, and then we can get back our finances once this organization is involved into financial difficulties. But then they have no voting rights. So preference shareholders, they don't take part in the management of an organization. So although they are given all these privileges, but then they may not take part, or they don't take part in the organization's management activities. So they cannot vote for board of directors, they cannot vote for policies within the organization, and then they cannot also influence how the dividends must be distributed within the organization. So that's the other way we can finance our operations in the organization, by using this as one of the long-term financing strategies in an organization. Questions, comments? Yeah.
Just maybe in our company, this advisor would not preference shares and having a loan for the company to grow.
No. So if the organization didn't make profits, then it means the organization will not distribute dividends to shareholders. So it means these people, they will not get profits because the organization didn't make profits. But then even if the organization has made 1,000 as profits, these people still get they'll still have a fixed rate. So if they have made 10,000, they are still getting 10% as their fixed rate from the 1,000. But then with ordinary shares, we have made only 1,000. The common shareholders, they may not be given this because their rate is not fixed in this organization. So, yeah. So we are continuing. So retained earning, another one. So this one is also part of the equity financing. So we said we have to be giving our shareholders dividends. So whenever we have made profits, we have to be giving our shareholders these profits. So we have to be distributing to these shareholders. But then an organization can decide not to distribute profits to shareholders. So we are not distributing profits because we want to increase our capital. So the profits that are made by our organization, they shouldn't be distributed. So we are not distributing these profits. But then we are plowing back these profits into the business. So we are getting all these profits, and then we are reinvesting these profits into our business in order to increase our capital. So that method, it becomes also a strategy of financing the organization, and it's called retained earning. So we are taking whatever we have made as profits, and then we are reinvesting these this money into the business in order to improve or to increase our capital resources. So that activity is called return earning, and it's one of the strategies of financing the long-term activities of an organization. So is this one okay? Huh? Huh? Okay. Yeah. So yes, so guys, so he has a question. He said, when we are not, when we are not distributing the profits when we are not distributing the dividends to the shareholders, can the organization have conflicts on because we are not distributing profits to the shareholders? So this process, it's one of the strategies that is made by the organization. So it is discussed by all the shareholders. So instead of distributing our profits, we have to retain these profits to boost our capital. So it means each and every shareholder has to agree. So the thing is, by retaining these profits, it means the cost per share will improve. So if one share if one share had a cost of, for example, 100 kwacha per share, so when we are returning profits to the organization, it means at the end of the day, we are going to have more sales as an organization. So this will improve the overall cost per share in this organization. So it means these people, they are investing into the future. So they will get more benefits into the future when instead of them using these profits. So some people say they didn't understand. Who are they? Yeah. Okay. So you have a business, you have a small business. You have a small business, and then your business has a capital of 10,000. 10,000. And then you use all the profits that are made by this business. But then this time around, you have decided not to use the profits. Instead of using the profits, you are reinvesting these profits into your business to increase your capital. That's what return earning is. So instead of using the profits, you are taking these profits and then you are reinvesting into your business to increase your capital. So if it was 10,000 and then you have made 2,000 as profits, you are not using this 2,000, but then you are adding this 2,000 to your capital to make it 12,000. So that process, it's return earning. Yeah. Yeah.
Organization that was also long-term as a financial. But I will explain more about it. Different shares.
Yes.
Meaning good solution area of my again my shareholders. They still not shares within at a fixed rate as
This one? Yeah, okay. So, okay, I said it can be a strategy which is made by the organization. So instead of sharing the profits, for only this year, we have to retain the profits. We have to improve our capital. So when we are retaining the profits, it means each and every shareholder will not get his or her profits, even if this person is a preference shareholder or is a common shareholder. So all shareholders will not get their profits, but then all the profits, they'll be retained in order to improve the capital. Yeah. So guys, another one, it's a debenture. So a debenture, it's a long-term loan. It's a long-term loan that is used to finance the long-term objectives of an organization. So a long-term loan which is used to finance the long-term operations of an organization. So now we are done with shares, and then we are on debt financing, whereby the organization is financing by using loans. So one of the loans that an organization can use, it's called a debenture. So this organization is securing a loan from the general public by issuing what we call a loan certificate. So this loan certificate, it's what we call this debenture. So in your mind, you have to see this debenture as a long-term loan that an organization will source from the public. So this long-term loan, we said it's unsecured. Yeah, so this term loan, we said it is so it's not secured. So by not being secured, it means it's not backed by a collateral. So what happens is that in most cases, when a person wants to borrow a loan from another organization, they must have collateral. So in Chichewa, it's called Chikole, yeah. But then these long-term loans, they don't have a collateral. So it means an organization is borrowing funds from other people or from the public by not using or by not having this collateral. So this process is not only used by the organization, but then the government can also borrow debentures from other organizations. So what will happen is that, so when during this process, an organization will come up what we call a deed of debenture. So it's just a document that that has the terms and conditions of this debenture. So guys, let's keep quiet. So we are saying, when an organization wants to borrow this long-term financing, they have to have what we call a deed of debenture. So it's a document, it's a legal document which has all the terms and conditions of this loan that the organization wants. So we want to borrow long-term loans. So we are preparing what we call a deed of debenture. So this deed, it's having the terms and conditions of the loan that we want to borrow. So it's having one, the time period of the loan, the interest rates of the loan, and also, for example, payment, how the loans will be paid. So this one, this deed is prepared by the organization. So the organization that wants loans, they have to prepare this deed of a debenture. So once the deed is prepared, it has to be marketed. So people have to know that this organization has introduced a deed. So an organization is marketing this deed to the general public. And then based on the terms and conditions of the deed, an investor can decide either to buy either to purchase this deed or not to purchase this deed. So by purchasing, it means this person is lending this organization money. So we have created the deed, the terms and conditions, and then we are marketing the deed, and then it has reached an investor, and then this investor is deciding to either purchase this deed or to lend money to this organization or not. So when he decides to lend money to this organization, then it means this company is financing its operations by using this finance from this person. So this one is part of a long-term financing strategy of an organization. So if you are going to find this on an exam, you have to be able to explain. So debenture. So these are long-term financing strategy of an organization. So yeah. Okay. So we are saying a debenture, it is a long-term financing strategy of an organization, or a long-term loan that an organization gets from the public. So it means the public is financing this organization's operations. So we said it is not secured. It doesn't have collateral. So an organization is borrowing money, but then without involving a collateral. So for an organization to borrow this money, it must have a deed of a debenture. So this is a legal document that has the terms and conditions of this deed. So we want to have this money. First of all, we have to prepare a deed of a debenture. So it's having things like the time period. So the time period where the debenture is expected to be paid back. It's having the interest rate. So the interest rate, so this, we define this as the cost of borrowing. So the interest rate of the overall debenture, and also other information, so means of payment, so other information considering this debenture. So once we have created this document, we can market, we can promote this document to various investors, to potential investors. So it will be the decision of an investor, after considering this deed, to choose either to invest in this company or to lend money to this organization, or to not lend money to this organization. So that whole process is what is called a debenture. So I hope it's clear on debentures. Okay. So types of debentures. Types of debentures. So the first one is called redeemable. So we have redeemable and irredeemable debentures. So these are debentures that specify the specific time period when the debts will be expected to be paid back. So we are having a specific maturity period or of a debt, whereby the organization, so on this one, redeemable, the organization is specifying when the debt or when the debenture is expected to be paid back. So that's redeemable. So an organization can prepare this document whereby they are specifying the maturity period of that debenture, or where the debt it is expected to be paid back. And then they can also have an irredeemable debenture, where there's no specific time period or a date where where this debenture is expected to be paid back. So it means an organization can also decide to prepare this type of a debenture. It's not specifying where this type of loan it wants to have, it will be paid back. So that's the first types of debentures. The other one is convertible and non-convertible debentures. So on this one, so we are saying these are people from the public, they are buying or they are lending an organization income. So on convertible, it means these are type of debentures where the people who are lending this organization's income, they can decide to convert these debentures into equity shares. So they are lending an organization income, so they can decide to convert this income into shares of an organization. It means they are now also becoming one of the shareholders of an organization. So for example, So for example, so you have, so an organization has borrowed funds from you as part of a debenture. So as an individual, you are deciding to convert these funds that you have given this organization to be part of the shares of an organization. So it means you are transferring your role in this case. So you are now becoming one of the owners of this organization. So that's convertible debentures. And non-convertible, it means they cannot be converted into equity shares of an organization. Secured and unsecured. So depending on the nature of the debentures, some of them, they can be backed by security. So you may have to have a collateral, but then some, you don't have to have collateral for you to access these debentures. So an organization that doesn't have collateral, it can issue this type of debenture unsecured. An organization that has collateral, it may use this type of debenture. So any questions on this? So these are the long-term financing strategies of an organization. Yeah. Okay. No, it has to. Oh. No, it has to be. Yeah, it has to be both secured and unsecured. So those were the long-term financing options of an organization. And then this organization can also have short-term financing requirements. This organization can also have short-term financing sources of finance. So it means we want to have finances for our day-to-day operations. So for example, we have to have finances for purchasing raw materials. We have to have finances for paying our wages, and then other expenditures within the organization. So how does an organization access funds in order to meet these day-to-day operations of an organization? So we also have several ways in which an organization would access money in order to meet these short-term or day-to-day operations of an organization. So yeah, we are on short-term financing requirements or working capital. So these are some of the short-term financing strategies of an organization. So an organization can use what we call a bank credit. So this is just a process whereby the organization is using the bank to finance its operations. So the organization is getting credit or is getting loans from the bank. And then we have customer advances, trade credit, factoring, public deposits, and also money market instruments. So let's look at some of these short-term financing strategies of an organization. So the first one is called a trade credit. So this is one of the simplest way on how an organization finance its short-term operations. So this is between the organization and so it can be between business to business transaction, whereby an organization is buying, an individual or an organization is buying things on credit from another organization. So whenever we are buying things on credit from another organization, it means as an individual we are able to use products, or we are able to use products without making immediate payments. So this one is on trade credit. So a person who wants to, an organization that wants to purchase raw materials from another organization, they may decide to go for credit purchasing, whereby they are buying these products on credit, so they are not making immediate payment. So this process whereby we are accessing products from another organization, but then we are not making immediate payments, it's called a trade credit. So it's becoming a source of finance because we are accessing products, but then without making immediate payment. So for example, in your organization, you want to buy raw materials, so you don't have money for the raw materials. And then you approach your supplier, and then you agree to the supplier to offer you the products, but then without making immediate payments. It means you are able to use the products, but then you are not paying for the products immediately. So it becomes a type of financing within the organization because we are able to use products from another organization, but then we are not making immediate payments. So that process is called a trade credit. So it can be done between a customer and a business. So a customer can also be a business. So a business and a business, they are transacting and then they are offering the products on credit. So that process, it's called a trade credit type of financing strategy within the organization. So how many of us use this type of financing? How many of us buy things on credit? So is it okay on trade credit?
Yes.
Is it okay on trade credit?
Yes.
So how many are saying it's okay on trade credit? Okay, can you explain? Yeah.
Correction. The way no trade repeated. Correction, wanapita. Kama kana correction. It's like umaiga visa. Umaiga drama kugagadi. Kadi makadi like that. In like children they use card but nobody have studied. Using cards. They use card to pay. No so mimi was makadi drama kama drama. Like mimi makadi ya visa the national card. It's the same as that. Makami drama ya na like so one else will makadi.
Yeah. So guys. Yeah. So, so guys,
like the supplier or the person who selling the product, we are capable of as my opening go very example, that's something salary. Really, the new business, I'll give it to the person. My brother will say, I will take it.
okay, okay, let's use this example. So these are two organizations. So let's use this example. So these are two organizations. So here we are on short sources or short-term sources of finance. So this organization doesn't have money. So this is another organization. So this organization wants to buy products from this, but then doesn't have money. But then it's still accessing the products because they're offered on credit. So that's the trade credit. So although we don't have money, we are still accessing the products that are offered on credit from this one. So it means we are being financed by other people's other organizations' products, but then by not making immediate payments. So this process is called a trade credit. No, you are correct.
There's also trade.
Huh? Okay. Okay. So okay, how many are taking accounting? So who are creditors and debtors? So when we are lending money to an organization, we become a creditor. When we are borrowing funds, we become debtors. No, debtors. Yeah, debtors. So in this case, it's about trade credit. So creditors buying without paying money immediately. So it's a debtor. Somebody who borrows money from another organization. So guys, so we are on the another source of short-term financing. So I'll be using examples. So on this one, so so we have we have flipper days. So guys, let's keep quiet. So we have so we are on factoring. So this happens when we have an organization, and this organization, so this organization has debtors. So it has people who must pay their funds to the organizations. So this organization has people who bought products on credit, so they didn't pay the funds. And then these people, they must pay back the funds. But then this organization, it has debtors, but then it needs immediate income. So they are having people who owe this organization money, but then these people, they cannot pay this money immediately. But then this organization needs immediate income for day-to-day operations. So what will happen? This organization, it will sell these debts to a company which is called a factor. So we are selling these people who owe money to our organization to this organization called a factor. So this organization it's also known as a factoring company. So it buys trade receivables from an organization. So it means after purchasing these debtors, these people who owe money to this organization, it will be between the factor and the customer now. So this one, it will be out of the relationship. So an example, okay. So you have a business, and then you have somebody who bought goods on credit to your organization. This person has to pay you back the funds. But then this person doesn't have immediate cash to pay you back the funds. But then you want immediate income for your day-to-day operations. You are selling this person to a company which is called a debt factoring company that buys these people. So once you have sold this whole person, it means the factoring company, they will pay you the funds that this person was supposed to pay you. And then it will be between the factoring company and the customer. Yeah.
For instance,
Okay, yeah. It was on credit.
Yeah.
But then, in most cases, these people, they have to benefit. So they are not going to give you the exact amount because they want to benefit. So if it was 1,000, so this person has to give you 1,000. These people, they can give you 800, but then they'll collect 1,000 from this person for them to have a profit of 200. So guys, on this one, have we understood? So have we understood on this one? So this is the next one. So this is the next one. So public deposits, it's another one. So it's also a short-term financing strategy of an organization. So it's called public deposits. So what happens in this one? So we are having an organization that wants money, and then this organization is collecting this money from the general public. So with public deposits, it's when the organization is sourcing short-term financing source of finance from the general public. So it means it's the same thing as the bank. So guys, let's keep quiet on this one. So it's what happens with the bank. So whenever you are depositing money into the bank uses that money for other purposes. So it means we are going to have so many people who will be investing to the bank as fixed deposits, and then the bank will be using all those money for other purposes. So when you need your money, the bank, they will give you. So it's also at an interest. So an organization can also use the same thing as the bank in order to find or to source for its short-term activities within the organization. So what will happen is that the organization, they will collect funds from the public. So they will convince the public to invest into the organization. And then these people, they will expect the organization to be paying them interest rates, so at an interest rate. So this is what happens. So whenever an organization wants to issue this, they will invite the public. So each and every person who is, for example, anyone who wants to invest into this organization. So once the organization has collected this money from these people, they use this money as their short-term financing strategy. But then these people who invested, they'll be given a risk for investing, which is called an interest. So this process, which is also unsecured because it's happening while this organization, it doesn't have collateral, it becomes another way an organization would finance its operations in a business, whereby we are inviting people to invest into the company, and then these people, they'll be getting interest, they'll be getting benefits in form of interest from this organization. So that is a public deposit. So the question would be, how is this different from a debenture? How is this different from a debenture? Yeah, so a debenture is for long term. This one is for short term. A debenture can be secured or can be unsecured, but then this one is only unsecured. So the last slide, so this is our last slide. So this is our last slide. So an organization can also use what we call a commercial paper. So a commercial paper is one of the, it's called a money market instrument, and it just refers to a short-term loan which is unsecured and which is used to meet the short-term operations of an organization. Money market instruments. So a money market instruments, these are short-term financing instruments of an organization. So the instruments that an organization uses for short-term financing. So one of it is called a commercial paper. So a commercial paper, it involves this loan, which is unsecured, which is not backed by collateral, which is issued by an organization. So this financial instrument, it involves coming up with a promising note. So whenever we want to have this type of loan, an organization has to come up with a promising note. So a promising note, it's just a document that shows that promises that the organization is going to pay back whatever they want to borrow from another organization. So these promising notes, they are going to be sent to the potential investors or from potential organization where the organization wants to borrow money from. So it's unsecured, whereby it doesn't involve a collateral. Organization shouldn't have